Every trader has felt the urge to call a top or bottom early, only to watch the market continue its trend. Emotional guesswork leads to mistimed entries and costly mistakes. But what if you had a set of road signs, clear, evidence-based signals that indicate when a turn is actually possible? In this framework, we present a systematic approach built on price action structures. By focusing solely on swing highs and lows, you can filter out market noise, stay with the trend until a proven reversal condition appears, and design trading plans around objective criteria. This method is not about predicting the future, it's about reacting to what the chart is already telling you. It helps you avoid the trap of premature entries and keeps you aligned with the prevailing trend until a genuine shift occurs. The structure provides a clear roadmap, reducing uncertainty and enhancing decision-making. At its core, every trend is defined by just two reference points, the swing highs and swing lows. An uptrend consists of a sequence of higher highs and higher lows, a downtrend, of lower highs and lower lows. The rest is noise. By collapsing a chart to these pivotal points, we strip away intraday wiggles and focus on what truly moves the market. This is not about every single bar, it's about the structure those bars create. Once you internalize this, you can identify when the rhythm is intact and when it begins to falter, long before conventional indicators catch up. This simplification allows you to see the market's true direction and avoid being distracted by minor fluctuations. It provides a clear framework for understanding price action and making informed trading decisions based on the underlying structure. Before a market can form a top, it must first stop making higher highs. The first sign of exhaustion is a lower high, a peak that fails to exceed the last swing high. But that alone isn't enough. Confirmation comes only when the price subsequently breaks below the prior swing low, establishing a lower low. This dual condition defines a completed top structure. Without both parts, the uptrend is still technically alive, no matter how overbought it looks. Waiting for this structural completion prevents acting on false alarms and keeps you aligned with the prevailing direction until a genuine shift occurs. This method ensures that you only act on confirmed reversals, reducing the risk of premature entries. It provides a clear, objective criterion for identifying potential tops, helping you avoid the common mistake of calling a top too early. Not all tops form neatly in three bars. Markets often churn sideways, creating congestion ranges where many bars remain within the high-low bounds of a single wide bar. These contained bars are essentially noise. They do not advance the trend in either direction. The filtering rule is straightforward: ignore all bars whose highs and lows fall inside the reference bar's range. Only the bar that finally breaks out of that range, pushing to a new low, counts as the completion of the top structure. This approach compresses complex consolidations into their essential elements, giving a cleaner signal. It helps you avoid being misled by minor fluctuations within a range and focuses on the decisive breakout. By filtering out noise, you can identify the true reversal point more accurately and make more informed trading decisions. The bottom structure mirrors the top logic. After a downtrend, the first sign of a potential turn is a higher low, a trough that doesn't undercut the previous low. But just as with the top, we need additional proof, a rally that pushes past the most recent swing high, forming a higher high. This sequence reveals that buyers have absorbed selling pressure and are now driving price upward with enough force to break resistance. Until the higher high is printed, the downtrend remains in force, and any bounce is merely a correction. The formula removes ambiguity and catches reversals early. It provides a clear, objective signal for identifying potential bottoms, helping you avoid the common mistake of calling a bottom too early. By waiting for confirmation, you can enter trades with greater confidence and reduce the risk of being caught in a false reversal. Occasionally, markets refuse to follow the orderly sequence. An extreme top occurs when price spikes to a new high but immediately reverses, slicing through the prior swing low without pausing to form a lower high. Visually, it's a two-bar shock, a sudden engulfing or outside reversal. Yet even here, discipline demands a third bar, one that makes a further lower low to confirm the pattern. Without that confirmation, the move could be a head fake. Extreme structures often accompany panic or euphoria, making them tradable only after the structural check prevents you from jumping into a fleeting momentum burst. This extra confirmation ensures that you don't act on a false signal, which is especially important in volatile conditions. By adhering to the structural rules, you can avoid being caught in a temporary spike and instead wait for a more reliable reversal signal. A completed top structure does not guarantee a downtrend. The market can still force fake participants by breaking back above the most recent lower high, resuming the uptrend. When that happens, the top structure is invalidated. The rule resets, the old high becomes the new reference, and we wait for a fresh lower high and lower low. Similarly, a bottom structure fails if price drops below the most recent higher low. This self-correcting mechanism prevents holding onto a stale thesis. It's a dynamic system. Respect the structure until the market proves it wrong, then pivot. This flexibility is crucial because markets are not always predictable. By having a clear invalidation rule, you can exit losing trades quickly and avoid being stuck in a position that no longer aligns with the market's direction. It keeps your analysis objective and adaptive to changing conditions. A complete price band is bounded by a top structure on one end and a bottom structure on the other. The upper boundary is the highest high within the top formation, the lower boundary is the lowest low of the bottom formation. The path between them is a distinct swing, a band, that captures one complete cycle of trend and counter-trend. Bands are the building blocks of all chart analysis. By connecting a series of higher bands, you get a rising trend, lower bands, a falling trend. Recognizing these bands allows you to set realistic targets and understand the rhythm of the market. It provides a structured way to analyze price movements and identify potential areas of support and resistance. By focusing on bands, you can better gauge the strength and direction of a trend, making your trading decisions more informed and systematic. Many traders confuse the 2B reversal with a classic double top. The distinction is structural and critical for timing. A 2B pattern occurs when price spikes to a new high, point C, above a prior significant high, point A, then reverses sharply below A. There's no completed bottom structure between the two highs, just a rapid retracement. In contrast, a double top features two distinct peaks separated by a clear trough that itself forms a bottom structure. That trough creates a full band, making the double top a slower, more distributed pattern. The 2B often signals a more aggressive, immediate reversal, while the double top suggests a more gradual trend change. Understanding these differences helps you choose the appropriate trading strategy and timing. It prevents you from misinterpreting a 2B as a double top and vice versa, leading to more accurate market analysis. Complex structures often feature prolonged consolidation. To measure how much of the price action is truly driving the reversal, we can calculate a containment ratio, the number of contained bars divided by the total bars within the structure. A high ratio indicates that most bars are trapped inside a reference bar's range, the market is coiling. Low ratio suggests frequent range expansion. The key observation is that breakouts from high containment zones tend to be more explosive, as energy builds up. This metric adds a simple quantitative layer to pattern analysis, helping to distinguish between a lazy consolidation and a coiled spring. By quantifying the degree of consolidation, you can better anticipate the potential strength of a breakout and adjust your trading strategy accordingly. It provides a more objective way to assess market conditions and improves your ability to identify high-probability setups. Valid trend lines are not arbitrary lines connecting any two lows, they must connect swing points that themselves are part of completed bottom structures, in an uptrend, or top structures, in a downtrend. Minor swings that lack structural confirmation are ignored. This rule makes trend lines more objective and reduces the subjective art of chart drawing. Similarly, popular wave theories like Elliott wave align cleanly with the completion of top and bottom structures. Each impulse wave and corrective wave can be mapped to a band. The structural filter thus provides a consistent foundation for many advanced technical disciplines. By ensuring that trend lines are based on confirmed structures, you can avoid drawing misleading lines that lead to incorrect conclusions. This approach enhances the reliability of your technical analysis and helps you make more informed trading decisions. Once a top or bottom structure is identified, a concrete trading plan follows. First, wait for the confirmation bar, the lower low, for a top, or higher high, for a bottom. Entering before completion is guessing. After confirmation, you can enter on a pullback or a momentum trigger, with a stop-loss placed just beyond the structure's extreme, the recent swing high for a short, swing low for a long. If the structure fails and invalidates, exit immediately. This simple, repeatable process removes discretion and ensures you only trade when the market has exhibited a clear, rule-defined signal. It provides a systematic approach to trading that eliminates emotional decision-making. By following these steps, you can improve your consistency and profitability, as you are only taking trades that meet your predefined criteria. Top and bottom structures are not crystal balls, they are road signs. A sign indicates a turn is ahead but doesn't force you to turn instantly. You slow down, assess, and act only when conditions align. In the absence of a sign, you keep driving straight. This philosophy filters out the constant temptation to react to every tick. It instills patience and discipline, key traits of successful traders. The market will always provide another sign, your job is to wait for it and then execute the plan you've already prepared. Treat these patterns as your navigation system, not as a holy grail. By adopting this mindset, you can avoid overtrading and reduce the impact of emotional decisions, leading to more consistent and rational trading behavior. We've deconstructed top and bottom formations into a set of clear, testable rules. From the simple lower high/lower low definition to complex containment and extreme patterns, the framework gives you a systematic way to read price action. Remember, no road sign, no turn. By integrating these structures into your trading, you can reduce emotional interference and trade with greater confidence. See you in the next one. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.